Well, hello and welcome to my Papasan chair. Guess what I did today from this chair? Well, mostly from this chair. Lots of taxes. Did my personal income taxes. Whoop! I got myself a Frappuccino reward for that one. And the other thing that I did tax related that's important and I want to share a little bit more about with you is called an 83B election. And 83B election is something that if you are part of a startup, typically is the context for it, but if you're part of a startup and you are granted shares, if you file an 83B election with the IRS within 30 days, 30 days is very important, within 30 days of being granted those shares initially, then ding, 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 you're the winner of only having to pay taxes, income taxes on those shares at the time of granting instead of the time of vesting, which is a huge relief. And the reason this is beneficial is because typically, like probably over 90% of the time, when you're granted your shares, when you're granted your either founder stock or your employee stock, it's typically done earlier in the timeline. And earlier in the timeline means the company's probably not worth as much in the earlier days. And so if you're only paying income taxes on the company in its earlier days when it's at a lower valuation, when those shares and that stock isn't worth as much, then your tax liability on them is going to be much, much lower, most likely. However, if you neglect to file your 83B election, or for maybe whatever strategic reason you chose not to file your 83B election, then you will be paying income taxes on that stock as it vests over whatever your vesting schedule is. So for example, my founder stock is going to vest over the next 4 years. So if I didn't do an 83B election, then over the next 4 years, every time I got those founder shares officially issued to me, like I'm now officially in ownership possession of them, then I'd have to pay income taxes on them. And again, assuming that we're doing a good job with the company, it's going to be worth a lot more later on down the line, and I don't want to have to pay taxes on that higher amount, income tax on that higher amount, as well as the fact that having to pay taxes on something that's worth quite a bit, yet what you're paying taxes on or what that income is an illiquid asset, is a share of a company, is a stock in a company, which is tied up, usually for good reason. It's illiquid. I don't want to have to, or most founders or employees aren't going to want to have to sell their shares, sell their stock, sell that income just to be able to pay the income tax on it. So all things considered, from what I can tell, this is actually Uncle Sam doing us a solid for once. So thanks. But yeah, that's what I've learned about the 83B election. And of course, I'm guessing, I am not a tax expert, so keep that in mind. I'm not a CPA. I'm just someone living this experience and sharing it. But I'm pretty sure that when I do go to sell those shares and that stock down the line, I'll still have to pay capital gains taxes on it, relative to, I'm guessing the basis would probably be whenever it vested. But again, I don't know that part for sure, but you'll still probably have to pay capital gains tax on the eventual sale of those shares of that stock. But yeah, again, the 83B election just makes it to where initially you pay the income tax on it up front when it's a much lower tax liability versus later when it vests. So that's good. And yeah, that's pretty much what I wanted to share.